Investor anxiety over the new tariffs from the White House leading to a reversal in stocks Monday afternoon from a big up session on Friday, which is seems so long ago. Joining us now with her view on the current state of the markets, Gabriela Santos, JPMorgan Asset Management Chief Market Strategist for Americas. It's the best of times, it's the worst of times, I think, and that's your point. If there weren't some of these external things happening, the base case is still pretty solid in terms of earnings and margins and the economy and everything else. But you don't know at this point how all this is going to play out.
I think the first thing that we do have to appreciate in moments where there is a lot of change is the actual underlying momentum coming into this moment. And we ended 2024 with real domestic final demand growing 3%. We had been surprised over and over with the resilience of the economy, especially the consumer. And we had, most importantly, a broadening in earnings growth, with the ex-Magnificent Seven growing earnings 15% in the fourth quarter, finally seeing margins start to improve again. So that's really, really important. This is a resilient economy with good momentum. That said, I think the markets are now trying to figure out exactly the decimal points for this year, which is a lot of function of a lot of cross currents in policy. And we do seem to be starting to see a cooling in the economy, but it's a cooling. It's not cool. So it's more just trying to figure out the contours around the edges. How does all this change in tariff and trade policy affect sentiment, affect capex, consumption, margins, revenue growth? How does the change in government spending also affect confidence, maybe employment? So how do all these different puzzle pieces fit together?
I wish it was just decimal points. And you're trying decimal points to the right.
That's right.
Of the
to
period.
The right. Yes, to the right of the period.
To the right of the period. When it starts affecting, according to the Atlanta Fed, it's actually affected numbers to the left of the decimal point for GDP.
And that, to us, seems like a bit of a, we don't want to overreact to what happened in 2 trading days, as the Atlanta Fed GDP now went from 2% to minus 2.8%. So there are 2 separate artificial issues here masking that underlying change. The first related to the import surge that we seem to have had. We're going to get more trade data this Thursday. What seems to have happened is a big surge in imports of gold, which is the BEA does not include in its GDP calculation. So just a mechanical thing there. And then the second one is related to sentiment. There has been a big decline, for example, yesterday, ISM manufacturing, but that's soft data. We have to actually see what's really happening in the underlying hard data. That's why this Friday's jobs report will be so important. And I think it can be a relief for investors to see that our expectation is we're still creating over 150,000 jobs. So there is still a continuation of momentum. It's more of a cooling. It's not cool. And for us, the underlying momentum is closer to 2%.
If you are right, the administration could make the case that if it's decimal points, this is when you'd want to make some of the moves for the long term to correct some of the imbalances that they see, whether it's trade, whether it's the size of government, whether it's government spending. You might be just feeding into the impulses of the administration to do it now instead of some other time.
And I do think it's going to depend on exactly how much we see all at once. It is starting to pile up.
And how long it lasts.
And how long it lasts. I do think there is somewhat of a consensus in the market right this second that maybe especially these 25% tariffs on Canada and Mexico are not persistent. We'll have to see the scope of the change, how long it lasts, and whether it's just these more recent developments that's affecting negatively the supply and the demand side of the economy, or whether we start to get some of the other policy aspects that are actually pro and boosting the supply side and the demand side of the economy and how those 2 interact. I think for the short term, while there is still uncertainty about this, what we saw in 2018 is a period of multiple contraction to try to factor in these different possible outcomes, and then eventually, if they are persistent, maybe start to factor that into earnings estimates.
But
So I would say just two quick implications here. The first is really that we had been talking about going into this year, just taking a look at the portfolio drift that might have happened in portfolios, a lot more exposure to risk. I see you see bonds doing their job with yields moving lower, the ag moving higher, 2.5%. So having some real growth diversifiers in there. And then the second is not turning too much to the cyclical trade quite yet. It's too early for that. It's usually out of a recession. So for us, it's diversifying within the market, but much more of a quality factor tilt for now.
We're going to have Howard Lutnick on. And he does just bull right. He always has an answer for everything and just, headlong into these things. But is it fentanyl? Is it dairy in Canada? Do we want factories built here? I don't know what. I'm not sure exactly what the end game is. Is it renegotiating the USMCA? I'm just not sure. We need to be clear on when we are able to take things off and what is it really fentanyl? Gabriela, thanks.
Are there concessions to closing the loop for China? That's important in the USMCA discussion.
We're all over the place, and they all have different factors.